How did the financial crisis at Souk-al-Manakh make history? The Souk-al-Manakh, Kuwait's unregulated stock market, experienced a meteoric rise and an equally dramatic fall in the early 1980s. The market collapsed overnight, wiping out billions of dollars in wealth and leaving thousands bankrupt. All of us are interested in making quick money, and most of you still believe it is the stock market that is going to help you double or triple your money in a short period of time. In the early 80s, many billionaires and rich people from Kuwait also believed that it was the stock market that would help them earn handsome returns in a short while. But they did not realize that they were committing a huge mistake, or that they would be part of history. Yes, it is the fall of Souk-al-Manakh in Kuwait, and one of the biggest blunders in financial history committed by a few people in Kuwait. So you must be wondering what exactly happened to lead to such a huge financial crisis. Between 1978 and 1981, the two stock markets in Kuwait, the unregulated Souk-al-Manakh and the conservatively regulated official market, grew to unprecedented proportions, surpassing the total amount of capital traded globally, with the exception of the United States and Japan. Wow, that's unbelievable. A year later, the system abruptly disintegrated, resulting in significant economic losses and financial turmoil that lasted for almost 10 years. But you must also understand that everyone associated with the financial sector around the world learned a few lessons from this episode in Kuwait. Two things can be learned from Kuwait's crisis. First, it is hard to distinguish between the banking and unregulated financial sectors, and second, regulators require comprehensive information on all financial institution transactions in order to comprehend the entire network that is necessary to preserve financial stability. The severity of the Kuwaiti crisis and its aftermath may have been avoided if Kuwaiti officials had access to transaction-by-transaction data on the trades being made in both the legal and uncontrolled stock exchanges. If you remember, the 1970s and 80s was marked by the rapid rise of Gulf countries, and Kuwait was one of the leading countries among them. In fact, Kuwait was the financial epicenter of the Gulf. The stock market in Kuwait was unregulated during that time, and due to this, a lot of people were interested in investing in the market. But alas, this mistake of not regulating the market led to one of the biggest financial crises ever in the finance sector. Kuwait served as the Arabian Gulf's financial hub in 1980. Other cities at the time, such as Bahrain, which was Kuwait's satellite market, and Saudi Arabia, with its broker-based stock market, were not advanced trading hubs like Kuwait. More stocks and trading occurred on Kuwait's exchanges than in any other Gulf nation. If you know anyone who has traded in Kuwait Stock Exchange in the 80s, they would tell you how easy it was to trade in the exchange in Kuwait, and also how big the exchange was. With 10 sizable banks, the banking industry was thriving and subject to agency regulation through the application of contemporary prudential techniques. The Bursa, Kuwait's stock market, was founded in 1977 after lessons were taken from the sharp rise and fall in stock prices during the preceding 2 years in over-the-counter trading. The foundation of stock market regulation was sound financial judgment and care, even by the standards of the 1980s, but this was not followed by the Kuwaiti government. But then there was something happening parallelly in Kuwait, and that was Souk-al-Manakh. Many in the financial sector will have at least heard this name after history was created at Souk-al-Manakh. Many Kuwaitis and foreigners realized that a less regulated market called the Souk-al-Manakh coexisted alongside the official banking industry and stock exchange. Here, fresh and inventive stocks that weren't traded on the Bursa could be exchanged in a cool parking garage that had been constructed over the former camel trading market. Regulators had taken reasonable steps to prevent the banking industry from becoming overexposed to the volatile financial innovation of the Souk-al-Manakh exchange, such as banning banks from lending money in order to purchase stock on the exchange. There is something that shocked many people at the time, and if you were to hear it, you too would be shocked. The amount of capital actively traded in the Bursa and the Souk-al-Manakh during this high oil price period was the third highest in the world, after the United States and Japan, even surpassing the capital moved in the London exchanges. Therefore, neither market was lightly traded. So you can imagine the size of these two stock markets in Kuwait. But then, when you can fool people and run such a huge scam, you should also not forget that this very system with which they had made money had the chance of collapse. Then in 1982, the inevitable happened. Not many people expected that to happen, but then, like every other financial crisis ever, the market just collapsed one fine day. This led to losses to the tune of billions. It was not just Kuwaiti citizens who were affected. There were many outsiders who were affected due to this financial crisis. It was the month of August and nobody expected it to happen. The entire banking system crashed in August of 1982. Nearly every significant player in the financial industry was impacted by the collapse, which happened so quickly and most of the players didn't know what they held or if they were solvent. When the Financial Authority ordered the turnover of all debts incurred on trades in the Souk-al-Manakh to regulators in September 1982, they discovered that the total amount of worthless obligations amounted to $93 billion, which is equal to $90,000 for every Kuwaiti, male or female. Just imagine the size of this huge collapse. To put it in simple words, the yearly income per person in America at that time was approximately $14,000. The chaos following the collapse lasted for several months. And when Iraq invaded Kuwait 8 years later, some of the disagreements that developed around the allocation of whatever resources remained after the losses were still being worked out. You must be thinking the entire Kuwaiti banking system and financial sector must have crumpled under this tremendous crisis. The answer to that would be that the Kuwaiti government was able to bail out its people and the financial sector, but then there were losses too. Ultimately, every bank in Kuwait but one was declared insolvent by the United Nations in 1989. The decline in value of the Borsa's equities damaged the exchange's reputation so much that after a few years, the government decided to resuscitate it in a new structure and under a new name, fully closing the Souk-al-Manakh. The recession hit the Gulf area as a whole. Yes, the whole of the Gulf fell into a financial crisis, just because the Kuwaiti government did not comply with the rules. In the end, it was an experience that encouraged Gulf countries to follow the regulations and guidelines of the stock market. Many still think that Souk-al-Manakh was formed for unregulated stock market trading. In a way, that's true, but then the formation of the Souk-al-Manakh is altogether a very different story. In basic terms, the Souk-al-Manakh began in 1978 when merchants got together informally to trade stocks that were exempt from the stringent regulations imposed by Kuwait's official stock exchange, the Bursa. Almost 40 equities of non-Kuwaiti Gulf enterprises were trading on the Souk by 1981. Because they saw the Souk-al-Manakh as a location where economic innovation could happen in a way that was distinct from the rest of the financial sector, authorities allowed it to emerge and function with little control. It was their goal that the Souk would provide capital for bold and adventurous initiatives that would draw in investors from all around the Gulf. But things didn't go as planned because there was a market crash in 1977 in Kuwait and the government was coming up with stringent regulations during that time. After the 1977 Kuwaiti stock market crash, the banking industry and the Bursa were severely regulated, and the Ministry of Commerce and Industry realized that these regulations' conservative nature may hinder innovation. The ministry introduced regulations aimed at preventing any interconnections between the regulated sectors and the unregulated exchange, even if it still permitted the Souk-al-Manakh to function. For instance, it was severely prohibited for banks to lend money or trade on the Souk in order to buy equities there, and Bursa issues were not allowed to compete with Souk offerings for stock. The interesting aspect at that time was that the only stocks that the uncontrolled Souk could trade were those that capitalized offshore companies, not domestic companies. The Souk could not be financed or borrowed from by companies on the Bursa or the official financial sector. The Kuwaitis sought to protect the conservative financial sectors from any hazards brought in the Souk, while also benefiting from a creative financial industry. Things didn't go as planned, and in the end, the creative financial industry failed miserably, only to go down in the books of history. Do you think the Kuwaiti government was also responsible for the unregulated stock market? If you have opinions on this, do share them in the comments section below. For more interesting videos, subscribe to our channel and do not forget to press the bell icon for notifications. Goodbye.